Good morning, everybody. Thank you for joining us for this Lunch and Learn. We will get started here shortly. All righty. Good morning, everybody. I hope everybody's doing well this morning, almost afternoon. I'm Robert Theobald, Small Business Ombudsman and Vice President of Small Business Services at the Arizona Commerce Authority. And I'm glad to be your host today for our Small Business Bootcamp Lunch and Learn with the SBA. As we like to do on the boot camps, we like to start by having everybody post up in the chat where they're tuning in from. I see we got Michael from Gilbert. Michael and I just talked this morning. So thanks for joining, Michael. But again, post up in the chat where you're tuning in from. We always like to see where our participants are from. I see Elaine from Prescott. Hello, Elaine. North Phoenix. We got Carefree, Surprise, Phoenix, Chandler, Gilbert, Flagstaff, Montana. All right. Andy, thank you for joining from Montana, Monterey, California. We are glad to have people from outside of Arizona join as well. So thank you. And you're always welcome to move to Arizona with your business. We like that too. We got Scottsdale, Sholo. Again, if you're just joining us, please post in the chat where you're tuning in from so we can see that. We just like to see where from throughout the state. And as we found today, other states are joining us. So we got Sun Lakes as well. Welcome, everybody. We're glad to have you with us. So if you're new to the Small Business Bootcamp, Lunch and Learn and the regular bootcamp, we could not do these webinars without all of our community partners. Their time, their effort, their expertise all come together to share their time with you to help your business and your knowledge grow. So we can't thank them enough for their time. Also, those that are new, the Small Business Bootcamp is a program we started back in 2020, and it started by just being a webinar series every Tuesday morning, which we continue to do every Tuesday morning. But we've also added workshops, lunch and learns, and special sessions. And so today is one of those lunch and learns that's part of the boot camp. And they're designed to help small businesses prepare, plan, and grow. And today's session, for example, is really going to focus on the planning and growing your business with some of the new products that the SBA is going to talk about. But the really cool thing about the boot camp is also our content library. So today's session is recorded, and all of our previous webinars are recorded, and we post those recordings in our content library, and you can access those at any time at no cost to see the recording and download any of the information that our presenters wanted us to share in that. So it's a great resource. The ACA also has a number of other resources to help small businesses. You can find these 6 and more at azcommerce.com/programs. We've got a number of things to help support small businesses and their growth, or even businesses that are looking to relocate to Arizona. One of the programs I always like to talk about is the Small Business Checklist. And this is designed to help small businesses that are getting started or expanding into new areas. Even, again, businesses out of state relocating to Arizona or expanding into Arizona. It helps them identify the commonly requested licensing, registration, and compliance requirements at the local, state, and federal levels. It can also help you find other information related to your industry, location, and many different things. It's a tremendous amount of information on the checklist. And if you scan that QR code, it'll take you right to it. We also have a piece on there. We have our virtual assistant, Sally, as part of our checklist. And you can chat with Sally, ask some questions, and see how she is doing. She's got some generative AI options as well. So it's a fun way to get some of the information from the checklist. This is just a quick look at our upcoming Tuesday morning webinars that we've got through October into November. And with that, we're going to jump into today's session. We're excited to have Craig Jordan and Pelson Lau, both with the SBA, the Small Business Administration. They are representatives covering this area, and they're going to talk to us about some of the new lending programs that the SBA has for small businesses. So I'm anticipating that many of you will have questions today in today's session. So at the bottom of your screen is a Q&A button. So if you can use that button to help ask the questions, it helps us track those and make sure we get to them in the time that we have. So with that, I'm going to stop sharing my screen and turn it over to Craig to kick this thing off.
Well, thanks, Robert and Faith, for putting this on. It's always an honor to be able to present. And Pelson, thanks for making yourself available. Pelson is our subject matter expert. He has underwriting experience in this particular product that we're going to talk about, which is more or less focused on lines of credit. But I did want to explain a couple things just so that you have a pretty good idea of how SBA works, is that all of our programs on the 7A side are done through participant lenders. So when I go over some of these lender bullet points here, it's really more or less focused on what the lender's responsibility is with how they govern this particular product. But you would actually go to a lender that participates in order to take out one of these lines of credit. They would handle that from cradle to grave. And to give you an idea what I do is I work with the lenders that participate in our loan program. So I try to find them if they don't already participate. And if they do participate, try to get them a little more active if I can. Train them how to originate, service, and liquidate those loans according to these rules that we're gonna touch on. But from the borrower's perspective, there's some very important points about this particular program, and I'm going to touch on those that you can take with you and make a decision as to whether or not you want to start down the path of finding a lender who could potentially approve one of these for you. So the working capital pilot program, what it basically is, or what a pilot is not a permanent program. They initiate pilots to take stock or take market information to see if a product is going to have traction. So they put these together, and we'll call it, pilot means kind of temporary in a way. And it's an additional program to ones that we already have in place. So it's important that you know as a business owner that this is just one product within a suite of products that we offer that are guaranteed. So there's other products that you can purchase, commercial real estate that you own or occupy. There's other products where you can buy a business. There's other products that you can do different things with that our lenders can also provide for you. It's just we're here to talk about this new program, this new specific specialized working capital pilot program. So keep that in mind. So what some of the things that were adjusted from old products, in other words, products that this pilot would supersede is fee structure. So for those of you that don't know, the guaranteed loan program has fees that it employs. What happens is every year Congress comes together and says, what is the fee structure that's going to minimize the impact on small business owners and also the taxpayer in order to subsidize the program. So the fees can range from year to year. This year, as an example, everything lower than $1 million is no guarantee fee to the client or to the small business. And then from $1 to $5 million, there can be fees, but they are part of the subsidy and they can be rolled into the loan. And so if you're looking at getting a line that's less than $1 million, there's going to be no fee. If you're looking at getting a line that's more than $1 million, there can be a fee. And so what I talk about when we go over the changes in the fees is going to be very important to you if your line is going to be more than $1 million. But generically speaking, the SBA loan program is loans up to $5 million. It is an 85% guarantee on the smaller loan amounts, so 150 and below. And then 150 and above, it's generally 75%. Now, there can be higher guarantees for specialized programs, like the one Pelson is an expert in. Some of our exporting programs allow lenders to hold a guarantee of 90% and above. And sometimes borrowers, if they really don't know how this works, they'll get confused by that. And what that really means is the SBA guarantees a loan. So we act a lot like an insurance company. We guarantee the loan so that the lender can mitigate a significant amount of their risk. So we're like an insurance policy. We don't actually deal with a lot of the front end elements of loan origination. We deal with it on the back end. So if the loan goes bad, then what the lender can do is they can turn in that insurance, so to speak, and get a percentage of guarantee. And so what that does is it makes them more readily available to take risk in these types of transactions. And what it does for the borrower is it makes it easier for you to get the loan in the first place, because normally the lender wouldn't be able to extend credit without that support of that SBA guarantee. So what is the working capital program? A new pilot program designed to do really three main things that will go into great detail. But what it's designed to do is cover asset-based types of lines of credit and transaction-based lines of credit, as well as our exporting products. The WCP is fully supported by SBA's team of export finance managers, which is important for you if you're a lender, if you're a resource partner, kind of coaching a borrower, or if you're a borrower, Pelson is our subject matter expert that can kind of walk you through your transaction to make sure that it's lined up correctly, that it's eligible, if there are facets of it that need to be analyzed any further, and you can reach out to him directly and you'll have his contact information. So just a generic overview. Again, it's $5,000. We talked about the loan guarantee. These particular loans are structured with a maximum term of 60 months. So they can be anywhere from 0 to 60 months. Most lenders, what they'll do is they'll do it as an annually renewable line of credit. And so that's how normally lines of credit are structured. In terms of processing, any existing lender, 7A lender, can do a 7A working capital line of credit. And it's important to know that, because if you do have a relationship with an existing lender, they can process this. Now, because it's a newer program, they may need a little bit of help. They may need a little bit of coaching, and that's what making sure that they can reach out to Pelson would be a solution for. The base rates are going to be prime plus SOFR. And for those of you that don't know what SOFR is essentially a short-term market index used to replacing LIBOR. It's called the secured overnight financing rate. So they can base their interest rates on prime plus or SOFR plus. Working capital follows the interest rate schedule for regular 7A for smaller loans. So this is just comparing what the regular 7A kind of fee structure is and how this new working capital pilot program is structured. And as you can see by just looking at the bars, that it is significantly less than a typical older line of credit product that has the older guarantee fee structure. Very similar to the way EWCP works, but without getting into the details of it, what we'll do is we'll go over a slide that kind of looks at what it would look like over a 5-year period. But what you can take away from this is it's significantly less than what a regular 7A line of credit looks like. And that's part of the reason why they created the product, because it was inherently an obstacle to put together a larger line of credit when you had these huge guarantee fees that had to be paid. So we talked a little bit about this. We talked about the guarantee fee structure. We talked about this EWCP program, which was one of our exporting programs that's now in a lot of ways encompassed inside, or an option for it is inside this working capital pilot program. But it allows lenders to utilize lines of credit the way they usually do, which is in 12-month increments with a 60-month term. The lender gets to set an independent loan maturity, but they can do it on an annual basis if they prefer, or like I said earlier, they can go up to a 60-month term. And those lines of credit can also be used to refinance. They can also be used for standby letters of credit, but under a WCP, that standby letter of credit has to expire before both the loan maturity date and the maximum loan term. And this is what I was talking about just a second ago. It's just kind of outlining the fact that this WCP has a much smaller and much more manageable guarantee fee structure. So I talked about the no fee this year, which does change annually or could potentially change annually. But if it's more than $1 million, you can see here, if it's less than 12 months, it's only 0.25% of the guaranteed portion. So when I talked about that 85 and 75% guarantee, what we're talking about is Whatever your loan amount is, if it's a 75% guarantee, it's 0.25% of that guaranteed portion. If they set the initial term at 13 to 24 months, it's 0.525, and going on down the line. But what you'll look for as you're looking at this slide is they're incrementally about the same, 0.25, 0.525, 0.8. Those are incrementally about the same. It's about 0.25% for each increase in the term. So when we talk about delivery methods, we're going to talk a little bit about how they can be structured. And this is kind of important, especially as a small business owner or as a coach, for you to kind of understand that it can be done in a number of ways. The first way is transaction, right? So that's a transaction. So think of a purchase order. That's specifically a type of transaction, but it can support single or multiple transactions during the term of the loan. It can pay vendors before billing revenue is received. And it can also function for a small business that has a large contract with different multiple milestone payments. And in this example, we're going to use ABC Vacuum, and we're going to say they have a contract where they're going to provide 3 industrial vacuums that can be partially deassembled and reassembled for a multi-stage, multi-tranche greenfield plant project. So what ABC is doing is having the components produced, work in progress, by multiple manufacturers nationwide, but needs funding to pay those manufacturers, build up that inventory to produce during those stages prior to getting milestone payments, from their client. So they could use a transaction-based working capital line of credit. They can draw on the line to fund the payments to their suppliers, which covers the cost of the direct labor and the material before they get their installment payments or before they get their invoices cleared by their client. So what does this do for the lender? For the lender, asset-based loans allow them to extend working capital against a pool of assets where they use a borrowing-based certificate. And for those of you that aren't familiar with it, think of it like a laundry list of the things that they can lien in order to lend you money. That's really what a borrowing-based certificate is, but it's usually, accounts receivable and inventory. So they're going to monitor that when they use an asset-based. An asset-based line of credit, a lot of times, is what you normally think of when you think of a line of credit. Like a HELOC works this way. The asset is the house. The HELOC is up to a certain percentage of the house. Very similar with this type of line of credit, except for the asset is generally going to be accounts receivable and inventory. And you can then draw off of that value or a percentage of that value of that receivable and inventory. So it lets you obtain a greater amount of working capital than what would typically be available under a normal revolving facility. They do provide flexibility to meet current and future needs, because if you have those assets, it's not basically transactional. So you can decide what is the best, use of proceeds for your business as long as you have the assets to support it. So it allows you to monetize otherwise illiquid assets as well, which are accounts receivable and inventory, to help you potentially fund upcoming purchases or overhead expenses, payroll, bills, things of that nature. And an example of an asset-based working capital line, ABC Company manufactures and distributes medical devices throughout the U.S. and overseas. Due to occasional shortages in surgical-grade stainless steel, management has been increasing their purchase of raw materials to ensure they have enough stockpiled. So they've dumped their cash into inventory preparation and work in progress. So they are carrying more inventory on their balance sheet, which has strained their cash position. So the asset-based working capital line allows ABC to access their liquidity against those accounts receivable and the inventory, so they can now access their line based on that inventory that they've created when they spent down their cash. So without the assistance of the WCP, ABC would not be able to borrow as much against their accounts receivable and inventory due to collateral requirements. So the lender can advance more funds against ABC's larger inventory position with the support of SBA's guarantee, which allows the business to access the working capital. So WCP was designed to provide lenders with the ability to support both domestic and export orders under a single facility. So export orders can be done under transactional and asset-based. What SBA defines as an export is a sale of goods or services to a foreign buyer, which falls under two categories. Could be domestic to foreign, which is the normal way we think about it, which is a transaction which the borrower sells to a foreign buyer and the goods leave a United States port, or a foreign to foreign export, which is where the borrower would be selling to a foreign buyer, but the goods do not leave a United States port of export. And it's important to note that foreign to foreign exports refers only to accounts receivables, as any inventory that's held outside the country would potentially be ineligible for that borrowing base. The use of purchase order or pre-shipment financing is also prohibited on foreign to foreign transactions without a waiver. And hopefully you can understand why that is. And that would be a situation where if you had that circumstance, reaching out to your export finance manager, subject matter expert like Pelson would help out quite a bit to make sure that you're doing that. You're doing that transaction properly. So let's talk about eligibility and requirements. One of the eligibilities that is a little different than standard 7A or standard SBA is the applicant does have to have a history of at least 12 months of operations prior to filling out an application. Under regular SBA programs, startups straight out of the box are eligible, but this is a specialized loan program. As I mentioned earlier, it's not permanent. It's we'll call it temporary or a testing ground. The other note is if it's an acquisition, if an acquisition took place recently, that acquiring borrower has to have a history of 12 months of operations in order to be eligible. The applicant also needs to be able to produce timely and accurate financial statements, AR and accounts payable agings and inventory reports, as the lender is going to have to use that either for their borrowing base or to review, the client's liquidity on an annual basis. And so again, for the lender is going to need to get updated financial statements on the borrower at least annually, perform a credit analysis, which coincides with any applicable renewal. And remember, the lender is deciding when it's going to be renewable up to that 5 years. So as a lender that participates in the WCP, it's important that the institution have normal operational controls to administer the monitoring requirements, which are going to mirror industry standards for most asset-based facilities. So we talked about this working capital based on a borrowing base. Working capital support qualified project or transaction. It's also important to note that those transactions can also be government contracts, right? So what's important about government, whether federal, state, or local contracts, the lender does not always have to obtain an assignment of proceeds if the term of the contract being financed is 12 months or less, or there is a successful track record between the applicant and the contracting authority relative to the same or reasonably similar contracts. That is important because other facilities that are out there many times require an assignment of proceeds, which if you've done any contracting, can be extremely difficult to process, both from a functional standpoint legally, because there's multiple parties to this, and also it's a difficult thing, and lenders just shy away from it. So if you're a borrower and you do government contracting at the federal, state, or local level, you may not have to get an assignment of proceeds underneath the transaction-based working capital pilot, as long as you have done similar types of contracts or worked with that entity before on a similar basis. So some other things: post-shipment accounts receivable finance, both lines of credit types can be utilized for that. Performance of standby letters of credit, again, related to short-term products, both. Temporary advances against a federal or state tax rebate can be done with a transaction-based working capital pilot loan. And there is some element of debt refinancing. And I would recommend, if you're looking at doing debt refinancing into this product, that you do pull up the program guide and take a real hard look at it to make sure that it's a qualifying transaction. Some things that you can't do with it: floor plan financing, which for those of you that may not be aware what that is, that's like basically auto dealer inventory. Auto dealer inventory is not eligible for this type of line of credit. Standby letters of credit that are used for only financial means, which is like things where you would need a standby letter of credit to support leases, equipment leases, or warranty bonds. It can't be used as a temporary advance against a federal or state income tax refund. But it can finance pre-shipment or purchase order financing for foreign to foreign export transaction. I'm sorry, it cannot. It cannot fund a change of ownership except for the following circumstances. This is where the WCP is going to be used for working capital, but not the acquiring financing or the acquiring loan, right? The business acquisition loan. So you can take out a working capital as long as it meets that, that time in business requirement. Working capital pilot loan proceeds may only be used to fund a portion of the change of ownership directly related to the accounts receivable or inventory as supported with a BBC or transaction-based. And where that can get confusing is sometimes an acquiring entity is, or a transaction is called an acquisition, even though the time in business stays the same. So think of it like if existing employees are purchasing the business from the existing owner, that's not necessarily considered a brand new business. That's considered, an acquisition, but it's an acquisition stewarded by an entity or a new entity that has experience running that business. So it's not considered the same thing. So the WCP provides flexibility that bridge the gap between rules and limitations of older 7A guaranteed lines of credit products. It is critical for small growing businesses and is economically and efficiently delivered through revolving lines of credit. The lower guarantee fees are part of that. It allows businesses to potentially take on new opportunities in a way that a term loan can't support. And the revolving nature provides an efficient means for businesses to manage cash flow and interest expense with the paydown feature and the reduction of obviously the payment obligation. The addition of the working capital pilot to the 7A program provides greater flexibility for lenders to structure comprehensive loan solutions for their clients. And it establishes the first government guaranteed facility that's specifically designed to support both domestic and international sales under one potential facility. Now, this slide just goes over where those subject matter experts are located. They are national. And you can see Pelson is our regional contact in Los Angeles, his phone number and his email address. And if you do have, specific questions outside of anything that's not answered today, you are welcome to reach out to Pelson or myself, and we will make sure that we analyze your situation, see if we can help you, maybe potentially even finding a lender if you don't have one. But one of the things I wanted to mention is prior to this presentation, I provided Robert and Faith the local lender master record, which is a lender list of lenders that voluntarily chose to provide their information so that we could hand it out to borrowers. And so that is a list that you will have access to where you can contact a lender. And as I said, any of them will be capable of providing a working capital pilot loan. And that list is designed for you to call the lender and you to reach out and make that contact. Embedded in the very top in the description of the particular document is also a link where you can go on to SBA's, we call it the lender match facility or system, where you can go into that system, put in demographic information about your business, your contact information, hit submit, and then SBA lenders will reach out to you. So there are really two ways you can get a hold of lenders. One is kind of the old-fashioned way, pen and paper, make some phone calls, talk to them about your situation. And then the other way is to go online, very much like any kind of like online loan agent or broker would work, except it's only giving your name out to SBA lenders that already participate in the SBA loan program. So with that, Robert, I'd be happy to turn it over. I don't see the Q&A, so I'm not sure if there were any Q&A questions in there, but there is time, I believe, to go ahead and answer some of those questions if they are in there.
Yeah, I don't see any questions. Please, if you have questions, post those in the Q&A at the bottom of the screen. I'm also posting in the chat the link on the website to that lender list. We will also have that lender list attached to the recording of this session on our content library.
So actually, there were two questions on the Q&A, and I already answered it. So I don't know those people ask the question. It's okay with my answer. If not, we can maybe talk about it now.
Yes, let's talk about those because others may have that same question. So it says, who determines the length of the loan?
So basically, as I said, basically it's the lender determine the length of the loan. The normally for line of credit is 1 year term, so they can renew every year. So another thing I want to particularly mention that, when we talk about renew the loan, from the bank perspective, they don't have to we submit the application to SBA. Basically, they renew it internally and go to the system to extend the maturity date. So that is kind of enhancement for our program.
Okay. And then another question was, is the WCPP loan amount separate from the $5 million max loan?
No, it's included the regular 7A loan. So let's say the maximum guarantee amount for 7A program is 3.75 million. So WCP guarantee amount will come together, will calculate together. So the both cannot be more than 3.75, which is the maximum guarantee amount.
Okay. We have a couple questions popped in. So we have one from Michael. It says, how do you get an SBA loan without collateral? Are there alternatives?
That's a very good question. Basically, what happened that, uh, in the past, lender bank, probably don't like to do line of credit, because line of credit there's no collateral, oftentimes no hard collateral. That's why the PCB program, we're saying that basically the trading asset, which is account receivable and inventory, will be sufficient to support the loan outstanding. So of course, banks sometimes maybe they will require additional collateral, but on our guideline, basically we're saying that the trading asset will be enough.
Okay. And then another says, does the company that has been in operation for 2 years but still pre-revenue qualify for this new pilot program, which allows the company to purchase inventory for future orders?
So the basic eligibility requirement for the WCP is the company has to be in business for at least 1 year. So it's not 2 years, 1 year. Which is 1 year they meet the requirement, which is eligibility requirement. But it doesn't mean that they will get a credit, but at least they will meet that requirement on that.
Even if they're pre-revenue?
What do you mean by pre-revenue? What do you mean by pre-revenue?
They're developing the product, developing technology, and haven't had any sales yet, but the business was formally created.
I think that's case, that's a credit decision. So absolutely the bank or the SB can look into that, Because
Okay.
maybe, it happened that they develop a state, they haven't had any revenue, but they have a order from domestic, and there's a number of factors to determine that. The key is that whether they can perform their contract. So that is the key to determine, Again, this is on a case-by-case basis, but
All right. Excellent. What other questions do all of you have out there? We got plenty of time to answer these. But we want to take advantage of having our experts from the SBA with us today. And they know the lending piece much better than I do. So again,
I want to add a little bit on great presentation, which is very good. But I just want to add a couple of things when you talk about the flexibility about this program. There's a number of flexibility we enhance the program. Number one, the fee structure already mentioned that. And I think that we mentioned about great mention about that, they can include international sales, which is a very good in a way that oftentimes when the lender provided line of credit, they will exclude the foreign account receivable. Okay, but in our program, they can include that foreign account reserve as a borrowing base, as long as they don't more than 15%. That is technical, but at least they can include that. That's one of the possibility. Another flexibility is that, when we talk about the asset-based lending, we base on the account receivable inventory. Normally, the bank, when they do this kind of loan, the advance rate is 80% on AR, 50% on inventory. But under the WCP program guideline, they can increase up to 85. 85% advance rate on AR, 60% advance on immediate. That means with the same trading asset, the borrower can borrow more money, That's a couple of things. Yeah. That's a couple of things. Just want to add on that.
Excellent. Thank you, Pilson. Well, I don't see any other questions, so we can go ahead and wrap up. We appreciate Craig and Pilson being with us to have information on this program straight from the SBA. It's brand new. It's just rolling out. So we posted in the chat the link to the lender list. We'll have the slide deck that Craig shared and the lender list as well, along with the recording in our content library, hopefully later today, so you can access that and see those links. But they're a great team. They're very responsive at the SBA when you have those questions to reach out, or you can contact me and I can get a hold of them as well. But with that, we will go ahead and wrap up today. Well, let's see. We had another question in there. Where can I watch this recorded? It will be in our content library on the Small Business Bootcamp homepage. So the page you went to register for this session, at the bottom of that page is our content library, and it will be in there. You just have to, it should be one of the first few options you'll see, but if not, you click on the See More webinars and you'll find it in there. So with that, we'll go ahead and wrap up. Again, thank you, Craig. Thank you, Pelson, for being with us. We want to thank all of our attendees for being with us today. And we hope you have a great rest of your week. And we hope to see many of you on next Tuesday's 9 a.m. at boot camp. Thank you and have a great afternoon.
Thank you.